All right, let's dive into something pretty fascinating. Today, we're going to talk about a new tool that tries to measure one of the biggest anxieties in all of finance, the fear of a recession. And get this, it's an index built not on dry government reports, but on what millions of us are typing into our search bars every single day. I mean, it's the question on every investor's mind, right? And it is notoriously hard to answer in the moment. By the time the economists in their ivory towers officially declare a recession, we're often already months deep into it. So how can we get a faster, better read on what's actually coming? Well, the core issue with all the classic indicators, think GDP numbers, unemployment rates, is what we can call the Rearview Mirror Problem. Now, don't get me wrong, they're incredibly important, but they tell us where the economy has been, not necessarily where it's going. Think about it like this. Relying only on that traditional lagging data is like trying to drive a car forward while only looking in the rearview mirror. Sure, you can see the road you've already covered perfectly, but you have absolutely no idea what's right there in front of you. And for an investor, that kind of delay can be really, really costly. We need something faster. And that brings us to a really innovative solution. It's a way to measure economic anxiety in real time, just by tapping into the digital breadcrumbs we all leave behind every time we search for something online. This is the Recession Fear Index, or as we'll call it, the RFI. So the RFI is built on a really simple, but honestly powerful idea. When people start to get worried about the economy, what do? They go online to learn more. The index captures this, what researchers call revealed attention, to give us this high-frequency, real-time signal of our collective anxiety. And the index isn't just tracking one word. No, the researchers identified 12 key search terms that people use when they're worried about a downturn. This slide here just shows a handful of them. We're talking about everything from the very straightforward recession to the much more dramatic, economic meltdown. And it's not just a simple count of these words. It's way smarter than that. The creators use a pretty advanced statistical technique to isolate the specific search behavior that actually has predictive power for the stock market, effectively filtering out all the irrelevant noise. So the big question is, does this whole idea actually work? Well, the data's pretty compelling. Let's take a look at the RFI's track record and what it's really managed to predict over the years. The main takeaway from the research is, well, it's unambiguous. In 11 major economies, we're talking the US, Canada, Germany, Japan, a spike in the RFI consistently comes right before a spike in stock market volatility. So this isn't just a US thing. It appears to be a global pattern. And let's put a hard number on that. A significant jump in the RFI, what a statistician would call a 1 standard deviation increase, is followed by an average 8.92% rise in annualized market volatility in the very next month. That is a substantial, meaningful economic effect. And what's really interesting is that this predictive power isn't just some short-term blip. As you can see here, while it's strong in the very next month, its effectiveness actually peaks around the 6-month mark. That gives investors a really meaningful window to react. And the signal, well, it stays significant even a full year out. So you might be wondering, why not just use the other indicators we already have? That's a great question, and this table kind of shows why the RFI is different. You see, unlike the famous VIX, which captures all kinds of market fear, the RFI specifically isolates recession anxiety. And unlike things like the yield curve or the unemployment rate, it gives us a timely, forward-looking signal of concern. But, and this is a big but, it is not a perfect crystal ball. The story takes a really fascinating turn when we look at the period after the pandemic. This is where the data reveals some pretty surprising twists. So check this out. Here's a powerful, kind of counterintuitive idea from Fidelity. They found that when Google searches for recession hit their absolute peak, we're talking maximum fear, the following 12 months in the stock market were positive every single time. This suggests that peak fear might actually be a buying signal, not a sell signal. Crazy, right? Now, context here is everything. The RFI's original data only goes back to 2004. That means it's only been tested by one major global downturn, the 2008 financial crisis. And that small sample size makes it really hard to know if it would perform the same exact way in a different type of recession. And in the post-pandemic world, things have just gotten, well, weird. The Cleveland Fed even noted that sentiment-based models like this one have been crying wolf, basically predicting recessions that never actually happened, all while the economy kept on growing. It seems the old relationships might have shifted. And finally, we have to ask a huge question. Who is actually behind these searches? Is it Wall Street pros doing deep research? Is it retail investors reacting to scary headlines? Or is it just the general public who got curious? The index can't tell them apart, and that adds a layer of ambiguity we just can't ignore. So with all these strengths and all these weaknesses, where does that leave us? What's the final verdict? How should a smart investor actually think about the Recession Fear Index? Here's the bottom line. The RFI is an excellent real-time gauge of anxiety, and it's a proven predictor of volatility. But what it isn't is an infallible fortune teller. You have to think of it as a powerful complementary tool, not a standalone crystal ball that you follow blindly. So for a sophisticated investor, the RFI can be used to monitor risk in real time. It can help time defensive moves, like hedging against volatility, and it can help guide those tactical decisions about when to lean into risk or maybe lean away from it, based on the level of collective fear in the market. In the end, the Recession Fear Index gives us a brand new lens to view the market through, a way to actually quantify a powerful emotion that drives so much of our economic behavior. It definitely doesn't give us all the answers, but it does leave us with a really critical question. Now that you can measure fear, how will you use it?